So we're going to move along with our discussion of individual taxation with now who's required to file a return. And the slide that your author provides you makes reference to three figures that are in chapter 1 of your book. And I went ahead and pasted one of these in here because I think this really does encompass most people. The other two figures are I guess less common instances where somebody might have to file a return. People who are claimed as an exemption on their parents' tax return. So if that's you, you may want to refer to one of those other tables in your book. But basically, in a nutshell, if you have income under the standard deduction based on your filing status, then you do not need to file a return. So if we think back to Bill in our first video, the single guy, and he had a standard deduction of $12,200. If Bill's gross income was less than $12,200, Bill didn't need to file. And I should point out that Bill was also under 65 years old. Had Bill been over 65 years old, and he gets that additional amount because he's older. If he was older and blind, it would have been even greater. But Bill could have earned at least $13,849 before this triggered an obligation for him to file a tax return. So this is often a question that young people pose to me a lot. Do I have to file a return? So in a nutshell, unless you are being claimed as a dependent on your parents' tax return, in which case you should look at some of the other tables in this chapter. But if you are filing independently, not as a dependent, then this is the table that applies to you. So you find your filing status, and again, head of household is only available if you have dependents yourself, not if you are a dependent. So if you are just a single person, no kids, or a husband and wife filing together, then these are going to be the columns that, or the rows, I guess I should say, that apply to you. So if you earn under these amounts, you are not obligated probably to file a tax return unless you meet one of the other criteria in your chapter. So then when must you file? So taxes are due on the 15th day of the 4th month of the year following the close of the tax period. What does that mean? Well, okay, so the tax period ends December 31st of every year for calendar year taxpayers. So the 4th month, January, February, March, April, so we get to April, and it's the 15th day of the 4th month, and that's how we get to April 15th, that magic tax day. Now, that is not a hard and fast day. There are some things that can cause that day to change. So, for example, Maine and Massachusetts, Patriots Day, if that falls on the 15th, then the due date defaults to 16th, and that's because of where returns are processed. And so because up in our neck of the woods, and I'm in Vermont, because Vermont has income tax, and my federal return would be impacted by the Patriots Day because it's often processed through the Andover campus. So often Vermont will follow that Patriots Day, and they will their tax day will roll over and match Massachusetts. District of Columbia has Emancipation Day, and if any of these happen to fall on a weekend, that will then throw all of this, or even a Friday. So if Patriots Day in Massachusetts happens to fall on Friday the 15th, you're then looking at a tax filing deadline, which will then land on that following Monday. In years past, we've seen a number of things that have impacted tax return due dates. specifically natural disasters. When we had an extension deadline in the fall, and we had Hurricane Irene come through, that was that delayed tax filing, and there were some adjustments made as a result of that. It has happened for, I think there was a flu bug one year. And then this year, for the 2019 returns, Congress opted to, well, it wasn't Congress, it was basically by the Internal Revenue Service, extended the April 15th filing date to July 15th as a result of the COVID-19 pandemic. So folks who had a April 15th due date received an automatic extension of the requirement to not only file the return but pay any taxes due until July 15th. Oops. Okay, so how do you determine what your filing status is? For most people, it's pretty clear, but for some folks, there may be some changes in their situation during the year that might not make that quite as clear. So who is single? Basically, it's determined as of December 31st. And so you can file single if by December 31st you were no longer married to one another. So if you are married filing separately, head of household, or qualifying widower, you cannot elect a single filing status. Similarly, if you get married during the year, you may file as married if you were married on December 31st, even if you didn't live together for much of the year, or really even much of any of the year. Similarly, if your spouse dies during the year, you can also file as married jointly in the current year. Married filing separately. I see this happen in instances where either the parties are separated and are moving toward divorce, or where one spouse has some concerning tax situations, we'll say, and the other spouse doesn't want any part of it. When spouses file jointly, there is a presumption that any tax owed belongs to both spouses. So if, for example, one spouse is engaged in business and has a pretty substantial tax liability as a result of the business, meanwhile the other spouse is a regular wage earner and has appropriate withholding, if they file jointly, both spouses will be assessed the liability from the one spouse's business. There are some things that the what's called innocent spouse can do in those situations, but for the most part, often in those situations, a spouse will just elect to file separately from, and then that will cause all of the liability from the spouse that has generated the liability to stay with the liable spouse. There is a filing status that is probably the most favorable, which is the head of household. And the reason that it is most favorable is that the tax rates are lower than either for single or married taxpayers filing separately. And the most important thing to remember, and I have seen this happen time and again with people who have brought returns in that they have self-prepared, is that I have seen married folks take the head of household filing status. It is not available to people who are married, plain and simple. So if you are married and your spouse has not abandoned you, you cannot take the head of household. And you must have paid more than 50% of the cost of keeping up the home that was the principal place of residence of a dependent child or other qualifying dependent relative. And so the one exception to the principal residence requirement is if the dependent is the taxpayer's parent, then they don't need to live with the taxpayer. So the taxpayer can be paying to keep mom in her home and still claim mom as a dependent and claim the head of household status, even though taxpayer and mom are not together. On the other hand, in all other situations, the taxpayer, the qualifying dependent needs to be living with the taxpayer, and the taxpayer must be unmarried to claim that head of household status to get that more favorable tax rate. You can have a qualifying widower with a dependent child, and so basically this gives the qualifying widower the benefit of the joint tax return rate, so they don't have to return to filing single for 2 years after the death of his or her spouse. And in order to get that, they must pay over the half the cost of maintaining a household with where the dependent child lives. So it basically eases the burden a bit when there's a sudden death of a spouse for the surviving spouse who is also raising children. So how do we determine how much tax an individual should have to pay? Now, unlike corporations, where there is a flat 21% tax, for individuals, there are 7 tax brackets for 2019, and it's based on income level. So, and it's based on that taxable income figure that we calculated. So those tax brackets range from 10% all the way up to 37%. So think about this. A corporation is only paying 21%. So they're, relatively speaking, at a fairly low tax rate compared to what individuals are having to pay. And I could rant on for hours about why corporations should pay their fair share of tax, but that'll be a philosophical discussion, probably for a discussion board topic on a different day. But that reduction in the tax rate for corporations is very recent as a result of the Tax Cuts and Jobs Act, and probably not a lot of Americans recognize that they are actually paying far more of their income in tax than most corporations are. So qualifying dependents. Before we had the Tax Cuts and Jobs Act, as I talked about before, you got an exemption for any dependents. So the taxpayer and their spouse you could get an exemption for each of those, and then any dependent kids. Those are gone. But just because they're gone doesn't mean that we ignore the fact that there are dependents. So dependent children can trigger the ability to obtain certain other tax benefits, such as the amount based on earned income credit, which we'll talk about later, has to do with the household size. Whether or not somebody can be considered head of household also depends on whether someone has a dependent. And a dependent can be either a qualifying child or a qualifying relative. So often we'll see instances where taxpayers are taking care of a parent or even a grandparent, or maybe a sibling, and so a sibling of themselves, their own younger siblings, and they could be considered a qualifying relative as opposed to a qualifying child. So who gets to be a qualifying child? And so you must pass a relationship test to be a qualifying child. So to be the qualifying child, you've got to be the child, stepchild, adopted child, and I guess a sibling or half sibling or a descendant of any of these. So if a taxpayer had a child and, for example, that child had a child, then the grandchild could also be considered a qualifying child for the qualifying child test, which is important shortly. Then the qualifying child must pass the domicile test. So the child must live with the taxpayer for more than half the year. And then the age test. Child must be under 19 or a full-time student under 24 and must be enrolled in at least 5 months of the academic year. And so this particular provision, the domicile test, is often a sticking point for parents who are getting divorced, because being able to claim that child, while there are no exemptions left, there are still potential other benefits. And the person who gets to claim that child is the person who has that child under his or her roof for more than half the year. And you will see parents go to battle in family court over wanting that child 6 months and 1 day out of the year so that they can claim the child on their taxes. So joint return test. So the child that you are attempting to claim cannot be filing a return with someone else. So if this child is married and filing a return with their spouse, they don't qualify as your qualifying child. The child has to be a U.S. citizen, a resident of the U.S., Canada, or Mexico, or an alien child adopted by and living with a U.S. citizen. And then there is a self-support test. So the child who provides more than half of his or her own support cannot be claimed as a dependent of someone else. And funds received by students as scholarships are excluded from the support test. So what happens if potentially the child qualifies as a dependent of more than one person? Maybe the child's living with a parent and a grandparent, or maybe the child goes back and forth between the two. Who gets to claim the child? Well, if one of the two people who theoretically can claim the child is a parent, parent wins. If both of them are a parent, and parents are presumably not together into this scenario, then whoever the child's with the longest wins. If you can't make that determination because maybe the child's going back and forth every other day, or it's 1 week on, 1 week off, then the parent with the highest adjusted gross income gets to claim that child. If there is no parent involved, let's say, maybe parents are deceased and grandparents are alternating taking care of a child, then the person with the highest adjusted gross income in that situation gets to claim the child. And again, we're back to parents who are separated or divorced. Whoever has the child for more than 6 months gets to claim. There are instances where a parent can, as a bargaining chip, say, I will give up my claim of deduction for this child, even though the child is living with me more. And because nothing is worse than having a parent or having parents fight over a child when all they really want is the deduction on their taxes for the child. They don't really have an interest in actually raising the child. So a parent who has the interest in raising the child and may not care about the deduction might say to the other spouse, you know what, I'll keep the child, you can have the tax deduction. So in order for that to happen, the custodial parent has to sign Form 8332, and non-custodial parent has to attach that to their tax return in order for the non-custodial parent to be able to take that deduction. Now, we move from qualifying child to a qualifying relative. And so we're looking at this when we're talking about the qualifying relative not being a child, stepchild, descendant of one of those. So this is, it says broad list of qualifying relatives. So you're taking care of grandma or somebody like that. And so in order for somebody to be considered a qualifying relative, they may not have gross income that equals or exceeds $4,200, and that doesn't count Social Security income. So if all they have is Social Security income, we don't have to worry about an income cap to have somebody be a qualifying dependent. And then it must meet the support test. Dependent must receive over his or her support of his or her support from the taxpayer. And remember the exception, so the qualifying relative must live with the taxpayer unless it's the taxpayer's parent and the taxpayer is paying to keep mom or dad in their home. This qualifying relative can't file a joint return with somebody else, has to be a U.S. citizen or resident of the U.S. And a taxpayer's child who does not meet the qualifying child test may meet the qualifying relative test. Well, who might that? So let's look at the situation where we have a 30-year-old disabled child. They don't meet the qualifying child test because they're over 19 and or over 24 and not in school. They probably are earning less than $4,200 a year outside of Social Security, but they are residing within the taxpayer's household. And so in that instance, it is the taxpayer's child, but they don't meet the criteria to be a qualifying child, but they may be a qualifying relative under the qualifying relative test. Now, as I've talked about a couple of times before, while there are not deductions on a sort of a per dependent basis the way there were for the exemptions, having dependents does open up the opportunity for tax credits. And we'll talk about tax credits more down the road, but a tax credit will reduce somebody's tax liability. And we'll go over that again. So I'm going to stop this video here and move on to the next one.